All right, Cathie Wood has new thoughts on inflation. It's time to get to it. Obviously, we know her thoughts on inflation. She believes deflation is coming, but she also has been warning about this for a while, and the CPI print that we just got came in at 7.7. One of the coldest prints we've had in a very long time. Let's dive deep. Cathie Wood, ARK Fund down more than 50% this year. It's time to understand how she thinks about inflation. She starts by saying, if inflation is unwinding as we believe, then we could be heading back to the future, the roaring 20s, the last time several general purpose technologies evolved at the same time: telephone, electricity, and the internal combustion engine. The setup is remarkably similar. So the first thing she's talking about here, have you ever heard of the concept of the roaring 20s? By the way, I actually asked a girl out on a date once in 2020. And I used the concept of the roaring 20s as like one of the hooks to the pitch to go on a date. She ended up saying yes to the date. It was pretty cool. I'm never going to forget that. But the roaring 20s was this time where America was roaring because we had all these different technologies that were coming together that were general purpose. They were not niche. The telephone, electricity, right? The internal combustion engine, cars, movement, mobility, transportation, all of this stuff coming together, intertwining. Cathie Wood believes this is happening in the context of blockchain, AI, robotics, and all these other different factors. And that's why she thinks it's a very exciting time to be alive. She says, prior to the roaring 20s, the world was at war, World War I, and suffering a pandemic, the Spanish flu. While both had a more serious impact on the global economy, today's combination is a strong echo that could result in much lower than expected inflation and a boom in innovation. She then says, during World War I and the Spanish flu, supply chain and other shocks pushed inflation to 20%, which was obviously bad, right? Inflation being at 20%. That's not a good thing. At its worst in June 1920, inflation peaked at 24%, but then dropped precipitously in 1 year to negative 15% in June 1921. We would not be surprised to see a broad-based inflation turn negative in 2023. Now, this is the part where either you're in the Cathie Wood camp and you believe this is happening, you believe deflation is coming, you believe inflation is coming down, you believe the technologies that are going to be deflationary are going to change the entire world, and that 2023 is going to be one of the biggest bull rallies ever. By the way, every year after a midterm since 1958, the S&P has rallied on average 15% higher than the year before. The year on the midterm year, it goes down. On the midterm year, it goes up. On average, since 1958, about 15%. So if we were to close at, I don't know, 4,000, let's say, and we rallied 15%, then the S&P would be at 415 or something like that. But no, 15% of 4,000. Hold on, we're going to do quick math real quick. So if we close the S&P at 15,000, 15 times 4,000, that would be 6. So we would be up 4,600 basically the next year. Now we're going to see if that trend stays, but Cathie Wood thinks it can get even bigger because inflation peaking at 24%, then going down to negative 15% June 19, 2021, obviously a pretty big deal. And maybe that happens again. She then says, founded in 1913 and challenged by its first bout of serious inflation, the Fed raised interest rates less than twofold from 4.6 to 7% in 1919 to 1920. Faced with much lower inflation this time around, the Fed has increased interest rates 16-fold, a serious mistake in our view. So she's saying the rate at which inflation is increasing is 8 times more than when it was, even though inflation is much lower than what it was. Now, I think the world is different. The world has changed. There's a lot more variables. We just had a pandemic. We had $7 trillion pumped into the economy. So there's a lot of different variables for why the Fed has raised interest rates as aggressively as it has. Obviously, we haven't had inflation this bad in the past 40 years. So if we haven't had inflation this bad in the past 40 years, the Fed is like, wait a second, we got to do something about this. We can't have inflation being this bad. And that's why they've been this cautious about it. Cathie thinks that's being overly hawkish. She says if inflation drops below the Fed's 2% target and economic activity disappoints, then interest rates are likely to surprise on the low side of expectations next year, ushering in this century's rendition of the roaring 20s. But that's if inflation drops below the Fed's 2% expectations. Look, if that doesn't happen, none of this makes any sense. But if it really does happen, or if even gets close, 3 to 4%, Cathie might have a point. As she also says, as inflation dropped to negative 15% in June 19, 2021, the Fed lowered interest rates from 7% to 4%, tripping the switch for the roaring 20s. From August 19, 2021 to September 1929, the Dow Jones Industrial Average compounded at an annual rate of 25%. Now, if that happens, if we have a decade where we are returning 25% year over year, which is what the S&P did, it rallied 28% in 2021. That was the rate of return in 2021 from 2020. I mean, that's just for doing that for 8 years. That's unheard of, right? And like, so that's why it's kind of like the world is so different from then. Could that really happen? But the setup that Cathie's talking about is all these different intersecting technologies coming together as one, and as a result of those technologies coming together as one, them being able to then influence and intertwine to be able to create these deflationary effects. Again, AI, blockchains, robotics, all of these things she thinks about. Genomics could be the version of the generic electricity and phones and internal combustion engines that happened in the 20s. If the Fed does not pivot, the setup will be more like 1929. The Fed raised rates in 1929 to squelch financial speculation, and then in 1930, Congress passed Smoot-Hawley, putting 50% tariffs on more than 20,000 goods and pushing the global economy into a Great Depression. Unfortunately, today is the echoes of the same. The Fed is ignoring deflationary signals, and the CHIPS Act could harm trade perhaps more than we understand. Much like the reaction to Smoot-Hawley, economists have paid little attention to the potential impact of the CHIPS Act. The University of Michigan's Consumer Sentiment Survey is at a record low, below levels hit in 2008, 2009, and 1979 to 1982, a setup for a liquidity trap like that in the Great Depression when massive monetary stimulus failed. Now, what she's talking about here with the University of Michigan's Consumer Sentiment Survey is a survey that is one of the most widely respected surveys around how consumers feel about the economy. And if it's at a record low, lower than it was in 2008, 2009, are we in a 2008, 2009 type of financial crisis where the stock market dropped 50%? No, we're not in that type of recession, right? We're only down about 10% for the year. Not, and at some level, if we end at 4,400, we're not going to be down 10% for the year in terms of the S&P. So at that point, like if sentiment levels are so low, it might be a misplaced level of lowness that is going to create this liquidity trap where even if you stimulate the economy, consumers are still going to feel like they don't want to spend, they don't want to participate in the economy because they have such bad sentiment to it that even might not stimulate the economy, even when you need to stimulate the economy. This is why we gave so much stimulus money, because we needed people to go out and start buying stuff because COVID had wrecked the economy and we needed to stimulate it. The problem is we overstimulated it and we printed a crap ton of money that caused inflation. So Cathie is saying that could be deflationary and not allow consumers to participate or have the sentiment to participate if we don't actually recognize that we're getting into a place where the economy is going to be good, not be bad, which is why the Fed shouldn't be hawkish. She then says, clearly we should be rooting against depression and for the roaring 20s. Given conflicting data and the stark difference in these outcomes, the Fed should be debating the possible risks associated with its current policy at the very least, instead of voting unanimously. And I think that's what Cathie's really arguing for at the end of the day. She's just arguing for the world to be a little bit more nicer, right? And not unanimously decide that everything's going to go to crap. Then you have Puru Saxena, who is a hedge fund manager or retired hedge fund manager from Hong Kong. And he has gone short the market. He has 312,000 followers. He's a pretty well followed guy in the Twitter world. And this is his argument. His argument is a bit different. He said, early in the year, I was of the view that most growth stocks had bottomed in May. Back then, I wasn't expecting the Fed would keep hiking rates into an inverted yield curve. The 10-year, 2-year U.S. Treasury bond spread inverted on 7th July, and it has now been inverted for more than 90 consecutive days, which is a valid inversion signal. Historically, this has been followed by a U.S. recession, no false positives. Furthermore, a number of leading economic indicators which I follow are also now forecasting a recession, which is why I am now operating with the recession playbook. The recession signals only flashed in mid to late October, which is why I've changed my view. When facts change, I will change my mind. So what exactly is the view that he has around why the recession is happening? Well, a couple of things. The 1981-1982 bear market did not end before the Fed pivot. The below chart shows the Fed funds rate, the bottom panel, peaked in 1981, yet the S&P kept declining and only bottomed in late 1982, which is what Cathie was talking about back when she said we had a big increase from 1982. No bear market has ever bottomed before at least a pause in the rate hiking cycle. So for Cathie to be like, yeah, we're just going to start going to the moon, deflation is going to come, Puru's argument is, hey, we have not hit a bottom, because the only way for us to hit a bottom is for there to be a pause in the rate hiking cycle, which means we stop hiking rates and then we start to consolidate and go from there. If we're going to continue being hawkish, if inflation is still going to continue being an issue, then there's no way that this Fed pivot makes any sense, or the Fed is going to pivot in the first place. He says recession seems inevitable now, and if earnings deteriorate rapidly, then history shows that even a Fed pause might not be sufficient to revive animal spirits. During several bear markets, the S&P kept declining even after multiple rate cuts, so nothing is set in stone. He also shows a chart that the Fed's fund rate peaked in mid-1981. as we can see right there, and the S&P bottomed in late 1982, which means that would be like if we were saying, okay, we're not going to increase interest rates anymore in 2022, and then in 2023 we have a bottom. As you can see, the S&P peaks in 1980, go down 27%. Volcker suggests the Fed may shift tactics October 5th, 1982. New all-time highs 1 month after Volcker considers ending the inflation war, and this entire decline erased 4 months later, right after that 27% decline happened, which means the bottom simply happened a year later after the rate hike stopped in the first place. So we're going to see if Puru, Saxena, or Cathie Wood is right about this question. Either inflation is going to go up and Puru is going to be right and the S&P is not done hitting its bottom, or Cathie Wood is going to be right and the deflationary effects that are supposed to make the economy go into the roaring 20s, as Cathie Wood said, is going to happen. Don't know which is true, but we're going to see what happens. Thank you guys so much for listening and watching. Leave your thoughts in the comments. I'll see you in the next one.